AI is hot, mega caps are hotter, but is your portfolio about to get burned? This is Inside ETFs, and we're talking about non-market cap funds. Ever since the AI boom took off, there have been warnings about a bubble. Tech companies are pouring billions into advanced chips and data centers, and the final bill may run into the trillions. Same question keeps coming up. What's the real return on investment for AI? Sean O'Hara, president of Pacer ETFs, says investors should look for ways to benefit from all that spending without having to bet on whether the AI business model works. So, Sean, what's the smarter way for investors to get that exposure? Is it time to start looking beyond the hyperscalers?
Our approach would be to not be on the spender side, but to be on the receiver side. In other words, a big chunk of that $4 to $5 trillion is going to go purchasing equipment. That's software, hardware, chips, networking, cooling systems, for example. And so we have an ETF, TRFK, Traffic. It sort of came out of another ETF that we have, Server, which we were very, very early on the data center story. We built a sector-based, just focused on publicly traded names that build data centers about 6 or 7 years ago. And then after that, we said, well, let's just take all the equipment out and just figure out what's in there and put it in piles, and let's build an ETF off of that. And that's sort of where Traffic came from. So whether or not, Google, Amazon, Meta can make money on their investment in building out these mega data centers or not, they're going to spend the money and they're going to buy the stuff that's in Traffic.
Well, your approach does focus on non-market cap weighting, but with US tech driving so much of the market's returns, doesn't that concentration just ripple through the entire market anyway?
There are names inside the Russell 1000 or the S&P, for example, where you've got companies that have as high or higher free cash flow margin than NVIDIA and are growing their sales and their revenues as faster. And those stocks have performed very well, but they're just such a small part of the cap-weighted indexes because of those 7 names that crowd out everything else. And so there's names in our portfolio like AppLovin or Ubiquity. We have an overweight to Palantir and Palo Alto. And so it's just a way to sort of diversify that growth exposure. I would think of it sort of like a barbell. It's nothing wrong with what's going on in the market, although it is starting to concern people because the valuations are so high and because a small number of names are controlling the returns on what's supposed to be a broadly diversified index. We're saying let's pull a portion of that and put it here to be truly diversified.
Let's dive deeper into another one of your funds, the US Large Cap Dividend Multiplier ETF. It leans heavily on income, but if earnings season does disappoint, does that income defense become a potential risk?
There's this bargain that we have to make between giving up growth and getting income when we focus on providing income from an equity portfolio. We think the solution that we built with QDPL, which is the ETF you just described, sort of doesn't make that same bargain. In other words, we're going to have about 85 to 90% of the money in the S&P 500. So you've got that growth piece covered. And then what we do is we use dividend futures to generate an income stream for the investor that's equal to 4 times the dividend in terms of percentage of the S&P 500. So you're getting an almost 5% yield on a portfolio that has the ability to grow faster than traditional dividend strategies or covered call strategies. Because with covered calls, essentially you're saying, I'm going to give away my upside in exchange for current cash flow today.
So finally, Sean, if we do get an AI correction or slowdown, which of Pacer's strategies is positioned to benefit rather than just hold up better?
Yeah, so there's this big debate going on right now, and there's sort of a transition, I think, that's going to happen one of these days, and it may be already starting to happen, which is this shift back towards quality or value. The last couple of years, the 2 factors that have been the big drivers for return have been momentum. So you think the big mega cap names, and low quality, which in the Russell 2000, for example, 40% of the names in that index don't make any money of all those small caps. That's 800 names. Those names are actually up more than the small cap index. And so that doesn't make any sense to me long term. Short term, you can have a little bit of speculation. And so as we start to shift back towards higher quality, and somewhat away from that momentum trade, we have 2 stories that we think make sense. One would be CowZ, which is our large cap value fund. If you look at it, for example, the last 5 years, I think it's outperformed the S&P 500. It's lagging recently, but over 5 years, it's beating that index with a PE of about 16 versus the 23 times we're paying to buy the S&P 500 today. And then for those who are sort of interested in that small cap trade, which may benefit from the Fed continuing to ease, we have a small cap version of that fund called CAF, get it, little baby cow. But we focus only on 200 profitable names out of the broad index that have high free cash flow yield. And traditionally over time, high free cash flow yield, particularly in small cap names, has been a real big determinant for where the returns will come from over time. You can go through these peaks and valleys where some of the lower quality stuff does well, but over time, the stock market ultimately works on fundamentals. If you grow your earnings, your stock should go up. If you don't have earnings, so you better get them faster. You're going to get penalized in the market.
That was Sean O'Hara from Pacer ETFs. Don't forget, you can watch more videos on Reuters.com.